Silver just did something that rarely happens without a hidden problem underneath it. 63. That is not a routine pullback. That is a trapdoor. Not months, not weeks. In a compressed burst of trading, the market repriced silver by more than 30%, as if someone reached in and yanked the floor out. And here's the part that breaks normal expectations. People were told moves like this couldn't happen anymore in a modern, well-managed marketplace. Not after refined risk systems, not after clearing reforms, not after the era of supposedly efficient discovery. Yet the tape printed what it printed. When a market moves this violently, it is almost never a calm vote on fundamentals. It is usually mechanics, leverage, collateral, liquidity. A chain reaction that begins in places most people never look. Institutions understand those reactions because they live inside the plumbing. Most of the public only sees the headline after the fact. And the difference between those vantage points is everything. A market distress signal rarely arrives as a siren. It whispers through rule changes, through margin math, through warehouse categories, through positioning data that looks boring right up until the moment it matters. What follows is not a prediction, and it's not a pep talk. It's a pattern, a sequence that has repeated across decades whenever silver becomes the most crowded, leveraged expression of a bigger story. Once you see the sequence, the recent collapse stops looking like a random accident. It starts looking like the first stage of a stress test unfolding in real time. Welcome to the quiet market, where we decode what matters before it becomes headlines. If you like analysis that sounds like the calm elder at the back of the room, the one who has seen cycles come and go, you're in the right place. And if you're watching from anywhere outside the usual financial capitals, comment where you're tuning in from, because silver is global, and the reaction to it always tells you who is awake. Now let's go forensic, because the signal is hidden in details most people scroll past. One date matters more than most realize: December 29th, 2025. That's when the CME raised margin requirements for March 2026 silver futures, moving the requirement from about $22,000 to about $25,000. If you don't live in futures markets, that can sound like an administrative tweak. In a leveraged arena, it is a forced decision. It is an extra demand for cash collateral at the exact moment volatility is rising and positioning is stretched. Margin is oxygen. When the exchange tightens the oxygen valve, the participants breathing hardest feel it first. In silver, the hardest breathers are rarely the people stacking coins for a decade. They are the leveraged participants using futures as a quick, scalable instrument. When margin goes up, some players can post more cash, others can't. And those who can't must cut positions, regardless of what they believe silver should be worth. Here's where it gets interesting. That margin change did not arrive after a quiet, sleepy market. It arrived into a backdrop where silver had been acting like a runaway train. By late January 2026, prices had surged to levels that shocked even seasoned traders. Then, almost as if the market hit a brittle point, the collapse arrived. 63, the move looked less like a normal correction and more like a liquidation event. Liquidation events have a signature. They don't move smoothly. They gap, they cascade, they accelerate as they go because the selling is not always voluntary. It's often compelled by risk systems and margin calls. It is concerned with survival. That is why a market can go from euphoric to brutal faster than the human brain can update its story. But the central mystery is this: why would a market anchored by physical metal behave like a leveraged derivatives product on the verge of breaking? And why, during the same window, were we hearing about strong investor interest, including reports of roughly $1 billion flowing into silver ETFs in January, while official vault numbers looked calm? To answer that, you have to accept a simple fact. Silver isn't one market. It is several markets stitched together. There's the paper market, where futures and options trade in huge size and can dwarf physical turnover. There's the wholesale physical market, where large bars move between vaults, refiners, banks, and industrial users. There's the retail market, where coins and small bars can become scarce even when large bars exist. And there is the narrative market, where people buy the story they want to be true. When those markets align, silver behaves like a metal. When they diverge, silver behaves like a stress instrument. Right now, the divergence is the signal. To see the playbook, go back to the moments when silver became the stage for a bigger drama. In 1980, silver became a symbol of inflation fear and monetary distrust. The move was explosive, and the ending was abrupt. Near the fever pitch, the rules tightened, margin requirements rose, and the cascade began. The result was not a gentle return to normal. It was a cliff. Participants learned painfully that in leverage markets, rules are part of the price. In 2011, silver ran again, fueled by post-crisis monetary policy, commodity enthusiasm, and a belief that hard assets were the only refuge. The pattern repeated. Volatility surged, margins were raised multiple times, and the market fell sharply. The world did not stop needing silver. The structure simply could not support the weight of leveraged positioning at those prices. In 2026, the same shape is emerging again, with one important twist: speed. The world is more financialized, the plumbing is more interconnected, and flows can shift across continents faster than most people can refresh a chart. The playbook still works. It just plays out faster. In each episode, the key similarity is not the headline reason people gave for buying silver, it is the sequence of mechanics near the peak: parabolic price action, crowded positioning, rising volatility, collateral demands, rule changes, forced liquidation. Then, after the shakeout, a period where the real stresses, if they exist, start to show up in the physical channels. That last part matters because many people assume the physical story must show up first. In reality, the derivatives market often breaks first, precisely because leverage concentrates there. The distress signal is not always a shortage of metal on day one. The distress signal can be a shortage of collateral. Now let's talk about the players, because markets don't move in isolation. They move through institutions with rules, incentives, and risk limits. At the center of the mechanics is the CME group, which runs COMEX precious metals futures. CME sets initial margin requirements and adjusts them based on volatility and risk. When volatility rises, margins can rise. When margins rise, leveraged participants must post more funds or reduce positions. This isn't moral, it is a safety system meant to protect the clearinghouse. Around that clearinghouse are banks, brokers, market makers, and large funds. Some are hedging industrial exposure. Some are arbitraging differences between spot and futures. Some are expressing macro views. Some are providing liquidity until the moment the risk is no longer worth it. In stressed moments, the changes that matter are not always loud. They are a subtle tightening of terms that ripples through the chain. Then there are the vault networks and reports that shape perception. The London Bullion Market Association publishes London Vault data, a snapshot of holdings across major vaults, 30% from the prior month. On the surface, that does not look like a world running out of silver. It looks like a system with plenty of inventory. Now compare that to the COMEX warehouse system, which breaks metal into categories like eligible and registered. Eligible is metal that meets specifications and sits in approved warehouses, but is not designated for delivery. Registered is metal that is specifically available to meet delivery obligations. That distinction can look like bookkeeping, but in stress moments it becomes the lens. 392 ounces, those are huge numbers. But the question is not simply how much metal exists. The question is what portion is actually committed to delivery and how quickly that portion can change when incentives shift. Add a third layer, positioning. 2,000 previously, that doesn't need to be dramatic to be meaningful. In combination with rising volatility and higher margins, it can signal the start of a broader unwind. Now put those pieces together. A margin hike dated December 29th. A record price on January 26th, a violent drop into January 30th, positioning beginning to reset. Official vault totals looking calm, and reported ETF inflows suggesting enthusiasm even as the structure cracks. This is the kind of contradiction that shows up when a market transitions from story to mechanics. Here's what it can look like step by step. The exchange raises margins. Brokers and prime financing desks tighten terms. Risk models reduce allowed exposure. Market makers widen spreads or pull quotes. Leveraged traders sell to meet margin. Price falls. Volatility rises. Higher volatility increases margin. Margin forces more selling. The spiral intensifies, not because everyone changed their mind about silver overnight, but because the system is forcing leverage out. This is the part many people overlook. In a modern market, the distress signal can be the system's attempt to protect itself. The very mechanism designed to keep the market functioning can also be the mechanism that creates the sharpest moves. Now we reach the dislocation, the point where two sets of data tell opposite stories. On one side, you have vault and warehouse totals suggesting there is plenty of metal in the system. London Vault holdings rising to 27,818 tons. COMEX combined totals over 405 million ounces. These are the calm numbers. On the other side, you have price action and collateral changes that look like panic, a 30+% crash in days. A margin requirement moved from about 22,000 to about 25,000. A sudden shift in mainstream language as if the entire story flipped overnight. These are the stressed signals. Both can be true because they describe different bottlenecks. The paper bottleneck is collateral and liquidity. The physical bottleneck is deliverability and willingness. You can have plenty of metal in vaults and still have a crisis in the derivative structure if the people carrying positions cannot or will not fund them. You can also have plenty of metal in total inventory while having tightness in the deliverable category. Eligible metal can sit. They're uninterested in becoming registered unless the economics make it worthwhile. Converting eligible to registered is a choice. It depends on spreads, financing costs, and the desire of holders to part with that metal under exchange terms. That is why the registered number matters. 444 ounces, that is the visible pool for delivery, but registered can shrink if holders withdraw or reclassify. It can grow if incentives encourage conversion. Stress shows up not only in inventory levels, but in ratios and in the speed of change. It is a configuration, extreme volatility, tightened margins, shifting positioning, and a structural split between what many people think inventory means and what delivery mechanics actually require. Now, let's make the mechanism simple, because complexity is where confusion thrives. Imagine a city with a massive reservoir. On paper, the city has plenty of water. But the neighborhood that needs water today is supplied by a narrow pipe. The pipe can only carry so much at once. If demand spikes and the pipe is constrained, you can have a water crisis in that neighborhood, even with a full reservoir. In silver, the reservoir is total vault holdings. The pipe is the deliverable system and the collateral system that supports paper claims. When margins rise, it's like the city demanding that every household keep more cash on hand before they're allowed to keep their subscription. Wealthy households comply. Leveraged households can't. They cancel subscriptions, not because they stopped believing in water, but because they can't meet the new requirement. That cancellation is selling. In futures, that selling can be brutal because it often hits into thinning liquidity. As price falls, risk models register higher volatility. Higher volatility increases required capital. Required capital forces more selling. The spiral is mechanical. Now layer in hedging and arbitrage. Producers and consumers use futures to lock prices. When a market is parabolic, producers may hedge more and some consumers may hesitate. Speculators may pile in. Then, when the reversal hits, hedging and speculative flows can collide. Arbitrageurs normally step in when dislocations emerge between spot and futures or between regions. But arbitrage requires financing, storage, and confidence that the trade will converge. In a margin shock, financing becomes less friendly and the appetite to run basis trades shrinks. That means dislocations can widen temporarily, confusing anyone who expects price to reflect physical reality instantly. But there's another layer that turns a crash into a diagnostic. Silver is both a monetary metal and an industrial input, and those identities pull in opposite directions. In calm markets, silver often behaves like a more volatile cousin of gold. In stressed markets, it can behave like a collateral-sensitive bet on growth, inflation, and liquidity all at once. That mixed identity makes it a perfect place for a system to crack, because not every participant is responding to the same signal. The public tends to assume price is pure truth. In leveraged markets, price can be the output of constraints instead of conviction. A fund can be right on thesis and still be forced out by a margin change. A market maker can think a move is irrational and still step back because balance sheet cost and risk limits have changed. When enough participants hit the same constraint at once, the resulting price can look like a verdict on fundamentals when it is really a verdict on funding. That's why the margin move from about $22,000 to about $25,000 matters. It is a tax on leverage. It says, if you want exposure, you need more cash. In a rising market, that tax cools enthusiasm. In a falling market, it can ignite a cascade, because collateral is demanded precisely when collateral is hardest to raise. Now look again at the inventory story. 30% from the prior month sounds like abundance. 392 ounces sounds like abundance. But abundance in a reservoir does not guarantee flow through a pipe. The deliverable slice is the hinge. 444 ounces is the pool reported as ready for delivery under exchange terms, and that pool can change quickly when incentives change. Here's where it gets interesting. When people argue about shortages, they often argue about the wrong thing. The real question is not whether metal exists somewhere. The question is whether metal will move into the channel being demanded, on the timetable being demanded, at a price that makes holders willing. That is a different question than whether there is metal in a vault. This is why paper versus physical can diverge. Futures can be collapsing because leverage is being forced out, while physical tightness in certain channels refuses to fade because the people who need immediate metal are not the same people who just got a margin call. You can have a day where the screen price is screaming sell, while an industrial buyer is asking a quieter question, can you deliver on time? In those moments, east versus west can show up as a difference in urgency. One side anchors on futures, benchmarks, and funding costs. Another side anchors on physical availability, fabrication lead times, and shipping constraints. Official totals can look calm while the lived market feels tight, and that gap is where dislocations are born. ETF flows add another optical illusion. An ETF inflow is a demand signal, but it is also packaging. It can represent new money, rebalancing, or short covering behavior that looks like buying. Reports of roughly $1 billion flowing into silver ETFs in January can coexist with a crash if the futures complex is undergoing forced selling at the same time. One channel can be absorbing metal, while another channel is liquidating paper claims. There's one more tell. When delivery chatter rises while screen price falls, it means the paper market is clearing faster than physical willingness. In past cycles, that's when the quiet stress becomes visible for anyone watching the plumbing. So when someone asks what should be watched now, the best answer is watch what institutions watch. Because institutions follow constraints, watch margin requirements and any methodology changes, because margins are a lever on leverage. Watch whether volatility stays high even as price stabilizes, because persistent volatility keeps pressure on collateral and keeps risk limits tight. Watch the relationship between registered and eligible categories, because that is where deliverability tightens first. Watch nearby spreads and the shape of the curve, because stress often shows up when the front behaves differently than the back. 7,000 contracts is the kind of small change that can hint a larger unwind has started. Now comes the part that matters most, what this configuration has led to historically. After a margin-driven liquidation that follows a parabolic rise, there are a few recognizable paths. A conservative path is stabilization through exhaustion. Weak hands are cleared out and price finds a zone where leverage can be rebuilt more cautiously. A moderate path is a second liquidation wave. The first drop triggers deeper de-risking across funds and brokers, and the market takes another leg down before it stabilizes. A more aggressive path, rarer but historically important, is a shift in the price regime where volatility stays elevated and the market reprices how much leverage it can carry for a long stretch. None of these paths are guaranteed, but the pattern shows that the first crash is often not the end of the story. It is a transition between phases, narrative and leverage, mechanical clearing, and then a new equilibrium where fundamentals reassert themselves. The signal is strongest when the mechanics and the narratives disagree at the same time. The point is not to chase a number, the point is to recognize the signal. 63. In days is telling you that constraints can matter more than story in the short run. Once you see that, you stop treating the move like a random accident and start treating it like a diagnostic test that returned an abnormal result. Here's the divide that matters. Some people will look at a 30% drop and decide the narrative is finished. Others will look at the same drop and ask, what forced that move and what does the plumbing look like now? The difference is not intelligence, it is attention. Markets often transfer wealth through attention gaps. Institutions move first because their systems measure risk in real time. The public moves later because the story reaches them after the mechanics have already done their work. That is not an insult. It is the structure of information flow. Silver, right now, is highlighting that structure with a spotlight. Silver's distress signal is not a siren. It is a set of clues. A record spike into January 26, a collapse into January 30, a margin increase dated December 29th, vault totals that look calm, registered totals that define deliverability, positioning that shifts as volatility hits, flows that contradict price action. These are the pieces. Hold those pieces together and the picture becomes clearer. Silver is functioning as a stress instrument, a place where leverage and collateral dynamics are being tested under pressure. Whether that pressure resolves quickly or evolves into a longer episode, the signal itself is worth understanding because it shows how fragile normal can be when the rules of funding change. This is the quiet market, where we decode what matters before it becomes headlines. If this connected dots you hadn't seen, you know what to do. The question isn't whether the market will keep testing itself. The question is whether you'll recognize the signal while it's still quiet.